Today, we're going to pull back the curtain on something called the foreign exchange market, or FX. You've probably heard of it, but it's one of those things that's kind of like the air we breathe. It's everywhere, it's essential, but you don't really see it. This is the invisible engine that moves trillions of dollars every single day, and it affects everything from the global economy all the way down to the price of your morning coffee. So yeah, let's get into it.
First things first, we have to talk about the sheer scale of this thing. The FX market trades about 6.6 trillion US dollars. Not a year, not a month, every single day. That number is it's almost impossible to wrap your head around. Let me try to put it in perspective for you. That's about 27 times bigger than the entire world's daily GDP. It is, by a massive, massive margin, the largest financial market on the planet.
So that's the big question, right? It's the biggest market on Earth, but how does it actually function? It seems impossibly complex, like this giant, decentralized beast. But really, it's a fascinating story of technology, competition, and evolution. So let's break it down. To really get what the market is today, we've got to jump in a time machine, because the world of FX has completely transformed in just the last few decades. And I mean, the evolution was just dramatic. Picture this. Back in the 70s and 80s, you had traders literally shouting orders into telephones. Then, in the 90s, we saw the very first sparks of electronic trading, mostly just for the big banks to talk to each other. But the real revolution, the Big Bang, that happened in the late 90s and 2000s. That's what completely blew the doors open and paved the way for the algorithmic age we're in today, where it's the machines that do almost all of the heavy lifting. So back in that old telephone world, the market was basically split in two. You had the interbank market, which was like this private members-only club where the major banks all traded with each other. It was super opaque. Then you had the dealer-to-client market. This is where everyone else, corporations, investment funds, had to go through their one bank. And here's the kicker. The clients never saw the real prices from the private club. They just got a quote from their bank, which meant they paid way higher costs. It was a system built on information asymmetry. So what was it that shattered this cozy little two-tiered system? Well, it was a wave of technological innovations that came along and just completely tore down the old walls, reshaping the entire FX landscape forever. The first big step came in the early 90s with electronic brokerages. These were systems that let the big dealer banks trade with each other anonymously and automatically. It created this centralized anonymous list to buy and sell orders, what's called a limit order book. Think of it like a massive efficiency upgrade for that private club. It was way faster, way more competitive, but it was still a closed shop, just for the banks. But then, around 1999, multi-bank platforms showed up, and this was an absolute game changer. For the very first time, a client, a corporation, a fund, could ask for a price from multiple banks all at the same time. This forced the banks to compete with each other directly for that business. And what happens when you have competition? Prices get better. The big, profitable price spreads the banks were charging their clients just started to collapse. This was the moment the walls of that private club really started to crumble. And the final key that truly unlocked the market was something called prime brokerage. This was a service where a huge bank would essentially let smaller players, like hedge funds, trade using the big bank's name and credit line. All of a sudden, these smaller guys could get access to the very best prices, the same prices the big players were getting. This opened the floodgates to a whole new class of participants and is what really fueled the explosive growth of the market. Okay, so let's fast forward to today. All of that incredible technological disruption has created the market we have now, and it's a totally different world. It's fragmented across dozens of different trading venues, it's unbelievably fast, and it is filled with a whole new cast of characters. And this chart right here, it really paints the picture of the new reality. This is for the spot market. That's the market for immediate currency swaps. Look at this. The old guard, the big dealer banks trading with each other, they now only make up about 22% of the market. A whopping 70% is now driven by other financial institutions. We're talking about those very hedge funds, smaller banks, and all the new players that were empowered by the digital revolution. Now, the most important of these new players are the principal trading firms, or PTFs. These are super high-tech, non-bank firms that use incredibly fast computer algorithms to trade for their own profit. They're not serving clients. Their whole game is about using speed as their primary advantage. And get this, they now account for a huge chunk of all electronic trading. At the exact same time, the big banks completely changed how they operate. Instead of the old hot potato trading where they'd get a client order and immediately pass it on to the interbank market, they now practice something called internalization. This means they take the massive flows of buy and sell orders from all of their clients and match them up inside their own systems. They're basically creating their own private little liquidity pools.
And this brings us to a really fascinating paradox. This quote from the source material just nails it perfectly. While all that early technology, like the electronic brokerages, made the market more transparent, the rise of internalization by a few massive players now has the potential to make it more opaque again, hiding huge volumes of trading away from the public market.
So this new world, hyper-fast, fragmented, it created incredible efficiency for sure, but it also introduced some brand new and pretty dangerous risks. The market basically needed some new, heavy-duty plumbing to keep the whole global financial system safe.
The most fundamental danger in any currency trade is what's called settlement risk. So imagine this. You agree to sell dollars for yen. You send your dollars, but before the yen arrive in your account, the other guy goes bankrupt. You're just left with nothing. And this isn't just a theory, it's called Herstatt risk after a German bank actually collapsed in 1974 and caused exactly this kind of chaos across the globe. The solution to this is an absolutely ingenious system called Continuous Linked Settlement, or CLS. It acts like a trusted middleman. Both you and the other parties send your currency to CLS. CLS holds on to both payments, and only, and this is the key part, only when it has received both payments does it release them at the exact same time. This principle is called payment versus payment, and it just elegantly eliminates settlement risk. It's now a cornerstone of the modern market. But there is a much more modern risk, and that is flash events. You may have heard of these. They are these sudden, incredibly violent price swings that happen in just a few seconds. They're often caused when all of those high-speed trading algorithms react to the same piece of news in the exact same way all at once. It's like a digital stampede that can amplify a small price move into a massive one and cause liquidity, which is just the ability to buy or sell, to completely vanish from the market.
Okay, so we've gone through all these mechanics, all this history. Let's pull back and ask the big question. Why does this invisible, super complex market actually matter so much to all of us? Well, here are the key things to remember. First, its scale. It's almost unimaginable, and it makes the FX market the absolute bedrock of the entire financial world. Second, it's gone through a complete technological revolution, going from a closed, telephone-based club to this wide-open, high-speed electronic network. And finally, that new world created brand new risks, like flash events, which in turn required brilliant safeguards, like CLS, to keep the whole system from falling apart.
And that leaves us with one last thought to chew on. We've watched this market evolve from humans shouting into phones to machines trading at nearly the speed of light. As that evolution continues, as trading gets ever faster and more automated, what new, unforeseen risks and challenges are just over the horizon for the world's biggest financial engine?